Well, welcome, and we are so delighted that you are all here with us this afternoon for this workshop on ARPA Project and Expenditure Reporting. This is one of an ongoing series of workshops run via our E311 program over the past 2 years, each pertaining to different facets of the federal disaster recovery funding. Bloomberg Philanthropies partnered with the U.S. Conference of Mayors in connection with this E311 program. And among other things, the past 2 years, we have hosted this series of workshops. We retained a panel of disaster recovery experts to work with cities one-on-one, answering technical questions about the funding. And you will hear from one of those team of experts today. Much of that guidance, technical support is captured on our E311 program's website, along with a wealth of other resources from the federal agencies, among other sources that provide guidance to cities about the rules and application of the funding streams. E311 is also a place for cities to share solutions, ideas, and questions with one another about the funding. So we are delighted that the E311 program has been accessed by over 5,500 city representatives from over 1,230 cities, and now with you all here with us today. So thanks again for joining us, and I'll turn it over to my colleague from Bloomberg Philanthropies, Jamie Lavin. Jamie.
Thank you, Rose. Next slide, please. It's our pleasure to introduce today's presenter, Matthew Hansen, who is an Associate Managing Director at Witt O'Brien. He has more than 25 years of experience in government program and grant management, finance, and agency operations at the federal, state, and local levels. Before joining Witt O'Brien, he served as Arizona statewide grants administrator, as well as the assistant director of the Arizona Governor's Office of Strategic Planning and Budgeting Economic Recovery Management Team. He supported the state's response to and recovery from COVID through administration of the CARES Act and other federal programs. Today, Matt will be discussing strategies for complying with the federal government's reporting requirements for the use of ARPA funds. Matt, the Zoom is yours.
Thank you, Jamie and Rose. It's an honor to be here today and to be able to present. Today's session is not intended to be a general training on Treasury's project and expenditure reports, but instead to touch on key issues, common problems, and hopefully some helpful hints and tips. If you're looking for more general training materials, Treasury has developed a series of very helpful YouTube videos, which can be accessed at the Treasury's Coronavirus State and Local Fiscal Recovery Fund website. I really must commend Treasury for going that extra step and putting those YouTube videos together, as they are, very helpful. Next slide. So critical to successfully complying with Treasury's reporting requirements is to stay up to date on the ever-changing guidance. On the slide are just a few highlights, but since the beginning of the program, there have been over 80 individual releases by Treasury of updated guidance materials, with the most recent ones impacting reporting occurring the first week of July. This is a trend that I not see ending anytime soon, unfortunately, as evidenced by the updated FAQs that were just released by Treasury on July 27th. So it is critical that you and your staff are constantly on the lookout for updated or revised guidance. For reporting, you should be looking about 30 days out from the next reporting deadline for updated guidance and reporting templates. As a side note, I am registered for Treasury's releases on their website, and it is hit or miss if I actually receive the updates. So please check Treasury's website directly, the E311, and other various sources to make sure you don't miss anything being released by Treasury. Here are just a few items from the most recent reporting updates. There were some technical changes to how state and territories have to report tax offset provisions. More relevant to this audience, however, are the new requirements around capital projects hitting either the $1 million or $10 million thresholds. The new written justification requirements will be a key allowability and compliance consideration going forward. So please take note of these and make sure you and your staff understand them, as this is how Treasury will ultimately be determining if capital projects are allowable or not. Next slide. One additional update to highlight in the July release is around broadband projects. More detailed information related to broadband projects is a trend you will continue to see as the federal government tries to align and measure the outcomes from various broadband funding streams, the Coronavirus State and Local Fiscal Recovery Funds, the Capital Projects Fund, and now the Infrastructure Investment and Jobs Act Fund. There is a lot of money coming down the road right now in broadband, and the federal government is doing its best to make sure the money's supportive of each other, that it's being graded correctly, and there's not duplication of benefit with those funds. You will also see a new requirement in the reporting to the FCC's Affordable Connectivity Program. Adoption of the Affordable Connectivity Program is a major focus right now, with certain areas of the country seeing more success than others. So Treasury and other federal agencies are using whatever tools and levers they have to drive adoption of this critical program. So just a little bit of backstory of why they're asking about the Affordable Connectivity Program. So as Treasury has transitioned from the interim final rule to the final rule, so have many of the individual expenditure categories transitioned. The next several slides will highlight some of the key changes and how you can update your reporting as necessary. The project and expenditure reports will continue into 2027 when final reports will be due. As we are still relatively early on in this process, now is the best time to go back and make any changes or corrections to previously reported data. As I'm sure you're all aware, something that was reported under the interim final rule might have had one expenditure category. Now under the final rule, Treasury has issued new expenditure categories, and the user guidance provides a crosswalk between those expenditure categories. Treasury has provided specific FAQs and instructions in the user guide on how to make these changes. These corrections can be made manually in the reporting portal or using the bulk upload templates. But please note, if using the bulk upload templates, that all information has to be completed. You can't just go in and update the expenditure categories. You have to complete all of the data elements. In some instances, this might be data that you did not originally provide when reporting previously. You will now have to do it now. If changes are significant, in addition to just expenditure category, it is best to practice to draft a memo to file, documenting the changes and the reasons for them. As I'm getting older, my memory is certainly failing, and trying to remember in January of 2027 why I changed something in August of 2022 will certainly be a challenge if I don't have a written reminder, let alone if we have staff turnover, and none of us can remember why we made the change. So memos to file are a tool you should use often throughout the life of the ARPA program. Treasury's bulk upload templates are your friend. They might not seem like it, but they are. As jurisdictions get further into their expenditure plans, the individual number of transactions will increase significantly, and manual data entry just will not be a reasonable approach. Unlike the CARES Act Coronavirus Relief Fund, where only a handful of states could use bulk upload templates for reporting, with ARPA, Treasury is allowing every jurisdiction to use the bulk upload option. So definitely a significant improvement there. Another change from the CRF reporting, it is not an all or nothing approach. With CRF, you had to pick manual entry or bulk upload. With Treasury ARPA reporting, you can do both. So it is helpful to start by using the bulk upload, and then you can go in manually and try and correct any data entry or validation errors. It is a much easier process than we had previously. If using bulk upload, please make sure you're always using the most up-to-date templates and not just copying templates forward from one reporting period to the next. This is a problem we've seen with clients across the country. They have the templates, everything validated correctly last quarter. Why isn't it validating this quarter? Is because Treasury's issued a brand new set of templates that are significantly different, and thus the validation issues. So always make sure you're using the most up-to-date material. As mentioned, you should look about 30 days out for any updated templates to be released from Treasury. In order to take the greatest advantage of the bulk upload method, you should collect your data from subrecipients, vendors, and other city agencies and departments in a manner that mirrors the templates as closely as possible. One jurisdiction that we worked with carried their CRF reporting methodology forward, which aggregates all data into a single file. They thought they had everybody trained, that this was a proven method, and why change it if it wasn't broken? Well, the reality was it was broken. This method requires a lot of manual effort, as the data then has to be disaggregated into the individual templates used for ARPA reporting. At the end of the presentation, I will share one example of how a jurisdiction mirrored the Treasury reporting process to make the bulk upload method as seamless as possible. Also, it goes without saying, but please make sure you follow the instructions exactly. Little things like rounding, changing the number format, missing decimal points, etc., will prevent your bulk upload data from validating. I ruined a Friday and Saturday 2 weekends ago because I had an obligation that was $10 less than an expenditure, and none of my bulk uploads would validate. So follow the instructions and check your information carefully. Next slide. So one common question we receive is, should I aggregate similar projects into one larger project or report in smaller increments, such as at the geographic location level? There are definite pros and cons both ways. For the first couple cycles of reporting, getting projects to validate in the Treasury portal has been somewhat problematic. So the fewer total number of projects that you have, the fewer validations that will occur. Going forward, however, the ability to directly tie financial transactions to smaller projects will be beneficial from a monitoring and reconciliation perspective. I do not have a specific recommendation, but just have just a suggestion. Have this conversation internally, decide on an approach, and consistently apply it going forward. For the first couple reporting cycles, I was definitely in the fewer projects camp, but now as we're getting more and more into it, having smaller, more discrete projects and being able to more closely tie financial transactions to those projects seems to be more and more appropriate going forward. Next slide. Just to provide an example, here are a jurisdiction has 10 unique affordable housing programs. They could all be reported separately as, housing project X in this neighborhood, housing project Y in that part of the city, or an aggregate. In addition to the validation pros and cons I just mentioned, you also now have the issue of hitting the $1 million and or $10 million reporting thresholds and the additional reporting requirements. While Treasury cautions about splitting projects into smaller pieces to avoid these reporting requirements, this is not the same thing as these projects can be justified as standalone initiatives. So just understand the ramifications of having 10 projects that might only be at the $1 million or even under the $1 million threshold, and what your reporting burden would be versus one larger project that might hit the $10 million threshold and what the reporting responsibilities would be to Treasury. So over the next couple of slides, I'll just do a high-level recap and flag a few recommendations for you going forward. Really want to leave as much time as possible for Q&A. Next slide. So be very precise when utilizing the bulk upload templates. The bulk upload process is a multiple-step process where you upload the template, then select validate to view any potential problems. One nice thing is that you can use the bulk upload to start the process and then make manual adjustments directly in the Treasury reporting portal to correct any errors. It's not an all or nothing process, which is very convenient. Make sure you always use the most recent versions of the templates and use the certification tab to see the validation status and whether the report is ready for submission. Next slide. One additional item to consider when discussing whether to aggregate or disaggregate projects is specific to the use of revenue loss. In Treasury's final rule, they have allowed for the use of coronavirus state and local fiscal recovery funds to be used as match for other federal grants, but only if the funding falls under the revenue loss umbrella. This is an area where you'll definitely want to disaggregate projects when reporting under revenue loss if all or part of the funding will or could be utilized as a source of match. I currently work with a city in Florida who had originally had all their funding reported as a single project under revenue loss and has now gone back to report as two separate projects using a different expenditure category. So a portion of the funding can be used as match for potential infrastructure investment and JOBS Act programs. So this is, an important piece, a strategic piece that you should look at now while we're still early in the reporting process. Also, please be prepared to routinely provide data on revenue loss if you're using the calculation method versus the standard allowance of up to $10 million. Treasury will add a new tab for each year, and the calculations will change based on the quarter and number of months since the baseline budget year. So the reporting portal will look different on this tab, and you'll have to provide additional data. This is not a big issue, but just confusing if you're not expecting to see the changing data. You'll go in one quarter and it'll say your potential revenue loss is X, and you'll go in another quarter and it might say it's Y, and that has to do with the number of months you are from the baseline year. If you use the standard allowance, you don't have this issue. It's only if you're using the calculation method. Next slide. So this might seem very basic, but if there's one takeaway from today's presentation, is to make sure you have an adequate number of staff assigned access in the Treasury portal. With the CARES Act Coronavirus Relief Fund program, you could only have 3 total users in the grant solution system. With ARPA reporting, you can have an unlimited number and they can have duplicate access rules. Probably the #1 problem we've seen across the country is jurisdictions having staff turnover and losing the ability to access the portal, request their second tranche of funding, or certify and submit their reports. If you're working with a consultant or other third-party entity, there's actually an access role titled Reporting Point of Contact that will allow them to input data into the Treasury portal, but not certify, submit, or take any other actions on behalf of the city. So I would encourage you to explore the use of that role, but make sure you have suitable backups and duplication of coverage, especially over time as you will experience staff turnover. Similar to this, it is critical to keep your sam.gov, id.me, and other e-government registrations up to date. As difficult as they were for many cities to establish in the first place, trust me, they are even harder to reactivate once they've expired. Sam.gov, as many of you know, is overwhelmed right now with the UEI transition, but trying to reactivate a sam.gov registration after it's expired could be a 60 to 90 day process involving certified letters, and you don't want to be there if you can avoid it. So put a tickler on your calendar to make sure to keep those e-government registrations up to date. So as mentioned earlier, the more you can do to mirror Treasury's batch upload process, the more efficient the entire reporting process is going to be. The example shown is from one of our clients in Alabama. The screen on the left is how city agencies, departments upload their reporting data, whereas the screen on the right is how the data can then be exported not only into the Treasury bulk upload templates, but also to serve as a transparency portal. This was just started in Excel and then was moved over to Power BI. Did not take a lot of time and effort to put together. Project and expenditure reporting is going to be with us for quite a while. So I would encourage you and your IT staff to invest a little bit of time and energy into formalizing the process. The number of projects, subrecipients, and transactions is only going to increase, making reporting that much more complicated. So we've really found this to be helpful, and we're exploring using it with other jurisdictions that we work with. Finally, just to sum up today's key points, be prepared to provide new data on previously reported projects. Treasury is certainly building the plane as they're flying it, and they're adding new data elements, new reporting requirements every quarter. Treasury is still issuing new guidance, so be flexible and realize that even older projects will require updated data from time to time. Spend the time now to fix any expenditure categories or other reporting mistakes from previous cycles. View the reporting requirement as a marathon and not a sprint, and invest the time on internal controls and formalized process, potentially including your own reporting portal or dashboard, separate from what Treasury requires. Make sure you have multiple people serving as backups, and understanding the reporting processes. You will surely have staff turnover over the next 5 years. Also, like any other federal government process or system, start early to make sure you don't run into system issues at the deadline. I certainly found slowness with the Treasury reporting portal the 30th and 31st this reporting cycle, as I think many people were last minute trying to get reports across the finish line. Finally, while Treasury does not make each individual project and expenditure report public like they do with the recovery plan performance reports, they do release aggregate data and highlights on the Treasury website. This is a good place to validate if the level of detail in your narratives is sufficient for Treasury. I know that's a question many people ask for themselves. Am I writing enough? Am I providing enough detail? Treasury really hasn't come out with good samples of what should be in the various narrative boxes. But certainly the projects that they're highlighting and the snippets of narrative that they're highlighting on their website give you a good indication of what they're looking for as far as responses. So use that as a resource going forward. And with that, I think we will open it up for some questions.
Great, Matt. Thank you so much. The first question that we've received is about how to get in touch with Treasury if you're having issues with the reporting portal. Are there things you found that have broken through sort of the boilerplate responses?
I have not had much success with the email, but they do have a hotline phone number that we can provide, and that seems to work better. Having you get a live voice on the phone line, and that works better than the emails. But it has been hit or miss. I would also suggest reaching out to them as early as possible. If you reach out 2 or 3 days before the reporting deadline, they're just overwhelmed, and your chances of getting a response are going to be slim.
So we'll share that phone number, the hotline, in the follow-up email we send after this session. I might also suggest they are having a webinar tomorrow that I posted in the chat on the new guidance that they've issued on housing. They usually do questions and answers during these webinars. So if there's something specifically you've been having trouble with, it's sometimes helpful to raise that in a setting like that where you might get a more individualized response or follow-up. The next question that we received, Vanessa Bryan, if you're here, would you want to come off of, would you want to unmute and share your question?
Sure. So let's say I have, one of my projects is we're making a park, and we are going to have some city staff that are going to be working on that, would we be able to include that labor or payroll expense within the Strong Healthy Communities Neighborhood Features project? Or would that labor need to be separated into the public sector workforce category 3 expenses?
It would be within the programmatic cost itself. So you would lump that into the larger neighborhood project and not as a separate project.
Okay, perfect. Thank you.
And, that's, just goes to kind of fundamental how you, allocate costs, whether they're programmatic, administrative, or indirect costs. In this case, it would make sense for it to be a programmatic cost.
Okay, perfect. Thanks.
Thank you. Our next question is from Mary Brown. Mary, would you come off of mute and ask your question?
Hi, yes, thank you. I have a question. It's also related to personnel expenses, but in the Treasury's portal, we found that it at least looked like they were wanting all expenses to be tied to an agreement or an award. So specifically those 3 tabs related to contractors, subrecipients, and beneficiaries. I'm curious how others are navigating that and how you actually report that labor.
What is the project of that labor? Is it administrative expenses?
Yes, for this most recent report, we were looking at our admin expenses.
So the way I've handled it is actually had a project titled administrative expenses and tied those payroll directly to that project. So
we did do that. We set up a project for, I think it's that expenditure category. It might be 7.1 for administrative expenses. And yet the only other option, unless we created like a contract or a subaward for our expenses, was to add everything into that section it's called like aggregate expenditures for awards less than 50K, I think. So is that how you manage that, is to just add the personnel, any expenses that aren't tied to an agreement, I guess, under that option?
It is. The other option is to use create a city agency or department as essentially a subrecipient for reporting purposes.
Okay.
So which works as well. It just creates a lot of confusion with monitors down the road because they will look at your reporting and say you've designated them as a subrecipient and they shouldn't have been a subrecipient. So it gets a little murky. Okay. I would recommend doing the aggregate transaction methodology.
Okay, great. And I actually have one more question, unless there's another question in front of me since I'm already off mute. So we also ran into a little bit of a snag. We noticed that for example, taking the subaward example, we issued, or I'll use a contract example. We issued contracts to consultants under our admin category to help us administer these funds and ensure compliance. However, the date that agreement was actually executed is what we listed as the subaward date or the contract date. And then the period of performance was for a date that preceded that actual executed date. It was, the clean first day of the month versus when it was actually signed a couple days later. And we realized that the eligible cost period was driven by the subaward or contract date versus the period of performance. I'm curious if anyone else has run into that issue. And I figured the way we would go about it is, one, just being able to justify whatever we put into our report. And so we just documented for ourselves, why we chose to include the dates that we did in those particular reporting fields. But I realized that I might be taking very literally the subaward date, and maybe I should align that with the period of performance in lieu of listing technically executed. But any advice there?
Definitely an area for a memo to file.
Okay.
I think you probably interpreted it a little too literally and probably could have the same date in both places.
Okay.
The other problem that folks are running into is when they're leveraging a city contract or a cooperative purchasing program where the original MSA contract or whatever was signed in 2018, 2019, which is before the covered period for the ARPA funding. So folks are having to arbitrarily put in March 3rd, 2021 and getting the report to validate. So just a really good example of where having internal documentation and a memo to file would be helpful.
Okay, thank you.
Thanks, Matt. We were also asked about the narrative snippets that you mentioned earlier in your presentation. Are there examples of those?
So on the Treasury compliance and reporting website, and we can provide that link in the follow-up email as well, but they highlight some different projects and they pull out language about how jurisdictions are tackling homelessness or veterans reentry or different issues. And it's those snippets that they highlight that I would recommend folks to look at as good examples to follow.
Great. And we've gotten a question from Lauren Frollo. Lauren, are you able to come off mute to ask your question?
Yes, I am. So we were also having a similar issue with entering expenses for personnel. If they exceed 50,000, and as the projects continue, we think some will definitely, be over that threshold. What is the best approach? We were finding there was errors if the personnel expenses were over that 50,000 mark.
And this is an individual receiving over 50,000?
We had grouped some of it within projects. So a couple employees under like a public health initiative had over 50,000. And we will see, I think, as we move forward, some individuals would be exceeding 50.
So at that point, it's probably best to, for reporting purposes, treat the city agency or department as a quote unquote subrecipient and report it like you would with a third party entity and not like just a city staff.
Great, Matt. And then we've gotten another question about the benefits and drawbacks of opting to calculate revenue loss. What is the motivation to calculate revenue loss in these reporting projects?
So the motivation is to maximize the flexibility that the jurisdiction has. So if you received over $10 million in ARPA funding and you're able to calculate an amount greater than the $10 million standard allowance, that creates a great deal amount of flexibility for the jurisdiction to fund projects that would not otherwise be allowable. To give you an example, we work with a city who was able to calculate about $60 million in revenue loss from their allocation. Because it's now revenue loss provision of government services, they were able to use that $60 million to offset existing payroll, creating $60 million worth of budget flexibility that's no longer federal in nature that they could use on infrastructure or other types of projects which would not necessarily be allowable under ARPA. So that's really the reason to do it for medium to larger jurisdictions. Certainly, if you're at or below the $10 million as a total allocation, take the standard allowance and don't even mess with the revenue calculation.
And you mentioned earlier that there's implications on whether or not you want to use some of these funds for federal match. Could you just give a little bit more information about that?
So pretty unprecedented with the ARPA program that they are allowing federal funds to be used to match other federal funds. That's usually one of the tried and true rules that you can't do it. When ARPA was first released, there were a couple exceptions around Bureau of Land Management programs, but for the most part, you could not use the ARPA dollars as match. When they came out with the final rule, they indicated that there is an option under revenue loss to use those dollars to match other federal programs. So certainly right now, when we have jurisdictions looking at going after infrastructure and other funding programs and struggling to come up with the necessarily match. If they have that capacity under revenue loss, that's a potential great opportunity for the jurisdiction.
Great. We have a question from Patrick Williams. Patrick, would you be able to come off mute to ask your question?
Yes. My question was, I don't know, and I joined late, and I apologize if this is a repeated question, but I had a question in regards to an agreement with a subrecipient who's incurred expenditures prior to the award date. One, is this permissible? And two, how do we define term start date in the agreement? Would it be the date of the award provided, or would it date back to when those expenditures occurred?
If that is an expense that you are going to reimburse the subrecipient for, I would recommend doing an amendment to the subaward, correcting the award date, making it an earlier date, and use that for reporting purposes.
Okay. Okay, so in the event that we're still working to get the agreement approved, would I start there, or would I start with the date that the award was provided and then go back and do an amendment?
If the subaward isn't even approved yet, I would just make all the necessary corrections whenever the subaward is finalized.
Okay, thank you.
Thank you. I have another question, which is, I haven't been able to find a definition for subaward type for the quarterly report. There are many choices like contract, direct payment, subaward. Treasury just relists the types but doesn't explain. How important is this designation?
It's very important, mostly from a compliance perspective, let alone from a reporting perspective. There are some really good resources that have been put out helping you do subrecipient versus vendor versus beneficiary determinations. But making that relationship decision drives what portions of the uniform guidance apply, what you need to do as far as monitoring, closeout. So it's critical that you have those conversations, you document those relationships prior to doing reporting, prior to entering into agreements. For the most part, the federal government is not going to question your decision if you consider somebody a subrecipient versus a beneficiary or a subrecipient versus a vendor. What they do want to see is that you've done that analysis and you consistently apply that approach to your various recipients. Where things have gotten really muddy with the ARPA funding is around subrecipients and beneficiaries. That's a concept that you don't usually have to deal with federal grants outside of sort of the safety net programs, but you do with ARPA. And it really has to do with how much programmatic discretion an entity has, whether they're a subrecipient or if the resources will be used for the benefit of just that organization, which would make them a beneficiary. So encourage you to go out and look at some of the resources that are online through AGA and others to help you make those determinations.
And I think Grace, who asked the question, is going to jump in with a little clarification on the question. Grace?
Hey, everybody. Thanks, Matt, for your answer. And I agree with you that the determination between a subrecipient, a contractor, or a beneficiary is of utmost importance. What I was having trouble with in the quarterly report is kind of further down the quarterly report at the end. You have a portion, I'm pulling it up right now. You have a portion under the expenditure and you have the project name, you have the subaward ID, and then you have the subaward type. And I could never find a definition for that subaward type. There's like 8 different kinds. There's like 3 different kinds of contracts that come under it, a direct payment. And I was looking through all of Treasury and I just couldn't find what each of those meant. And so I had them already as a subrecipient or a contractor or a beneficiary, but I couldn't find the definitions for that particular box of information.
And this is where it has like, I think like one of them is purchase order and, you know, yeah, I wish I had a great answer for you. I think it's really jurisdiction by jurisdiction to kind of define those for your own jurisdiction and what they would fall into.
So just be working with my finance department on that, and we just need to come up with what we're going to call each of those. Okay, I've been doing that, but I'm an attorney by trade, and so that makes me really uncomfortable when I have to choose something that feels like it has a definition to it, and I can't find the definition. Oh, and somebody answered some of my questions, so great. Thank you.
Great, and thank you, Susan, as well. And I totally get it, Grace. Us lawyers think alike. And so for our next question, I'm going to turn it over to Nicole Remacher. Nicole, do you want to come off mute and ask your question?
Hi, this is kind of more for the Treasury. I'm just trying to understand, what does the expenditure section add as far as what's provided in the project overview? We enter the obligations, total expenditures, et cetera, but I'm not seeing what additional information is being provided. It just seems repetitive to me. So just curious if you had a take on what the expenditure section adds in comparison to the project overview.
I wish I don't have a good sense of what Treasury was trying to accomplish other than just another form of validation of data.
Makes sense. Thank you.
Great. And I think we have our last question from Casey. Casey, do you want to come off mute? Ask your question.
Hi there. This is Casey Brock Wilson from Boston. Thanks, Matt, for this presentation. One of the projects we have is focused on acquisition of small properties in support of affordable housing. And so, you know, the project is grouped together in one kind of pooled fund, but supports many small capital expenditures through acquisition. One of the issues we've been having is that there's a $10 million threshold for projects of over 10 million in capital expenditures for that kind of triggers Davis-Bacon. I don't know if you've seen this in other municipalities, but how they deal with that threshold for a project that is large in the way that Treasury defines projects, but contains a lot of small capital expenditures within it.
No, I mean, this is exactly what I tried to touch upon. You know, Treasury has cautioned jurisdictions to arbitrarily break up projects to avoid compliance requirements, but if there is a rationale for managing projects in smaller increments, I'd certainly, you know, encourage you to take advantage of that. I think if the project has always been discussed as one large project, it was approved by your through your process as one large project, it'd be difficult to break it up now. But if it was always planned as a series of small initiatives that at some point got aggregated together, you know, either to go through the expenditure process or some other approval process, then it would make sense to manage them at the smaller project thresholds. Davis-Bacon and some of the other compliance requirements when you hit the $10 million are certainly going to be a deterrent that might prevent some projects going forward. So, you know, would encourage you to, you know, put some thought and effort into that. We've seen both. We've seen jurisdictions, not specifically because of the $10 million threshold, but for other reasons, break projects into smaller pieces, either because they have different project managers, they have different timelines, they have different funding mechanisms. And we've seen other projects where it's all housing, let's keep it all together and deal with the various compliance requirements. So I wish I had a better answer for you, but it's one of those oddball issues with the ARPA funding. You know, CDBG in many ways is helpful because it is so black and white, and you know the compliance requirements for all your projects.
Thanks, Matt. Do you have any anticipation, given the new guidance on affordable housing that was released at the end of, or in mid-July, if some of the rules that are, or compliance aspects that touch on housing may change because of that new guidance?
I certainly think it's still an ongoing discussion by Treasury. I don't think the FAQs that were released on the 27th will be the end of them when it comes to housing projects. So I think the stakeholders are doing a great job of communicating to Treasury sort of what they need in order to fund affordable housing projects with ARPA dollars. And I think we'll continue to see some revised or hopefully relaxed guidance when it comes to affordable housing projects.
And I just posted in the chat the link to register for tomorrow's Treasury webinar on that new guidance. So hopefully they'll provide a little more information that goes beyond the FAQs there. I'm going to launch a poll. We take your feedback seriously and would love to understand how we can continue to tailor these presentations to help your cities prepare for upcoming reports and make sure that you're effectively deploying these federal dollars. And then I'll turn it over to Rose. Rose?
Great. So if everybody has completed that poll, we'd just like to thank you for doing that. I want to give a huge thank you to Matt Hansen, who wasn't feeling great today, but did not want to miss this presentation, and he did not disappoint us by providing just a plethora of his own knowledge, expertise, and resources that cities can tap into. So Matt, thank you so very much. I also want to thank Cobray and Kim for helping to put this program together today. And just a couple of other quick conclusions and announcements. Last month, some of you might know, in partnership with the U.S. Conference of Mayors and Results for America, Bloomberg Philanthropies launched the Local Infrastructure Hub, which is a national program designed to connect cities and towns with resources and expert advice needed to access the federal infrastructure funding in order to drive local progress, improve communities, and deliver results for residents. The Hub has hosted 3 webinars so far focused on the Safe Streets for All and Reconnecting Communities programs. The next session is on August 16th and will be focused on closing the digital divide through broadband funds. Mike Bloomberg will be featured and will be joined by Andy Burke, Special Representative for Broadband at the U.S. Department of Commerce, and Francella Ochio from the Next Century Cities. Jamie Lavin will post the link to register for that session in the chat now. And additionally, the Local Infrastructure Hub will be opening enrollment for its deep dive technical support in partnership with the National League of Cities this Friday. So stay tuned for more information on that. And thanks again to everybody for joining us. And please feel free to put additional questions for Matt to him through the E311 hub, which Jamie has provided the website to and is here. We will continue to answer your questions one-on-one as they come in on this and any other topic pertaining to the ARPA funding. So best of luck to all and have a great rest of the day.